Welcome to Hub Hits. Today we're asking the question, is Canada going broke? Yeah, you heard me right. What's happening with our debts and deficits? They're certainly growing. What are the risks, and what are the risks to you as a taxpayer? Are your taxes going to go up as a result of Canada's record borrowing set for this autumn's budget? To help break it all down, I'm joined by Speer, co-founder and editor-at-large. Sean, great to have you on the program.
It's great to be talking to you, although I wish it was about a different topic.
Yeah, the death and taxes. Well, we'll leave the death part out today, but we are maybe going to talk taxes. But Sean, give us a sense of what the conventional thinking is in Ottawa with regards to debts and deficits, because we have seen a massive escalation, really starting before COVID, but supercharged during COVID, and then interestingly after COVID, continuing record deficit spending, and all signs pointing to a big fall budget here in Canada that some think tanks are arguing could see a deficit in the order of $90 billion. Yeah. Does Ottawa think this is a problem?
Well, Rudyard, if you've been following public finance issues in Canada for a long time, you'll know that in the 1990s at the federal level and across several provinces, we saw significant fiscal reforms that eliminated longstanding deficits and actually started to make progress on reducing net debt as well as the country's debt to GDP ratio. And we rightly heralded those developments as a step in the direction of stronger public finances. So much so, in fact, Rudyard, that we came to have the strongest balance sheet in the G7. We went from having one of the worst to being threatened as the northern peso to becoming a country that distinguished itself from others because of our relatively low levels of public debt. That's a story that we continue to tell ourselves, independent, as you say, of some of the big trends that we've seen over the past decade, essentially a doubling of the federal debt and massive debt accumulation in the province of Ontario and other provinces. And so there's a way in which the story we tell ourselves and the reality is no longer aligned. And in fact, we published an essay by you today that I'd really encourage our listeners and readers and viewers to check out, because it gets at the heart of this growing gap between the story we tell ourselves and the fiscal reality. Why don't you talk a bit about it for our audience?
Yeah, sure. Well, so look, the story we like to tell ourselves, Sean, is one of some complacency. We know we have this AAA rating. We have a much lower debt to GDP ratio than the United States and a lot of other advanced economies. And Mark Carney himself has kind of indicated that these are, the foundations, the basis for possibly a very significant budget this fall with a very large deficit, because, hey, we can do this because we have this AAA credit rating, because we're nowhere close either in total debt to GDP as the United States is, or even our deficits as a percentage of GDP are much smaller than the US. Well, I decided in a piece today, Sean, inspired in part by my conversations with you, to take a look at some proxies for this. So what if we put the policymakers aside and try to go to Mr. Market and try to ask Mr. Market, well, what do you think about Canadian versus U.S. debt? U.S. debt, again, very high deficits, very high growing debt to GDP ratio. Let's have a look at the key chart that appears in my piece. So what this is comparing is two different ETFs. So ETFs are exchange-traded funds, and their value rises and falls, in this case, because they're bond funds, on whether interest rates are going up or down. So if interest rates are going up and borrowing costs are increasing, the value of the ETF, the bond ETF, falls, because investors want to get compensated for the portfolio, which had been assembled and purchased and valued when rates were lower in the past. Now rates are higher, so they want more money, because they're losing money based on all those previous bonds in the portfolio. So here we're looking at two ETFs that could be proxies for long-term government debt in the United States and Canada. ZFL is Canadian long-term debt. We're showing that in the red line. And TLT is a famous ETF that is basically long-term U.S. debt. So these two different ETFs have a what's called a duration of the portfolio. So the very close to each other, almost exactly an average duration of all the bonds, i.e. when they were originated versus when they pay out, of 16 years. So what this is showing, Sean, is that the value of the Canadian long-term government debt has fallen precipitously since the start of the year. It's down over 6%, or just at that 6% line, whereas the United States, despite all of its deficit spending, despite a much worse debt to GDP ratio, is down less than 3%. Again, that's the blue line, TLT. And my argument is this is showing that the market increasingly does not like, guess what? Canada's long-term debt. It's asking, in a sense, for compensation, higher yields, again, higher borrowing costs, and that is reflected in the falling value of the Canadian ETF here, the ZFL. Final point, look at that line, March 2025. Well, what happens between March 2025 and April 2025? There's a Canadian election. And look how the line has plunged on since the election. Look at the extent to which Canada's borrowing costs, not for short-term debt, not the overnight rate or even the 5-year bond, but in this case, bonds with an average duration of 16 years, our debt costs have gone up considerably. The interest rates on those debts have risen, and they've risen counterintuitively much more than Donald Trump's profligate United States.
Yeah, great setup, Roger. I want to spend some time drilling into the numbers and the different factors behind them. You mentioned the election campaign in March. Since then, of course, listeners and viewers who follow our channel closely know we've been talking a lot about the growing tension between some of the things that Prime Minister Carney says he wants to do. He wants to lower taxes, he wants to boost defense spending, and he wants to balance the budget in 3 years. And I interpret this graph, and I want to get you to weigh in on this, in some ways the market betting against his ability to square the circle on these different priorities, and in fact, assuming that what we're going to see is more deficits and more debt, and in fact, that problem not getting better, possibly getting worse over the longer term.
Yeah, so you're bang on, Sean, because remember, these rates, these longer term rates, what's called going out the yield curve, they are not as affected, in fact, maybe hardly at all, by the short-term rates that the Bank of Canada sets, the overnight rates. These are rates that are much more, in a sense, a market. All those bond buyers, the whole universe of bond buyers in Canada and around the world, making future bets, future projections about whether the cost to borrow for Canada will go up or down. And what we've seen since the election is a bet reflected in these ETFs, particularly the ZFL, long-term Canadian bond index, that the borrowing costs are going up. And they are going up because, again, not what the central bank might do in the short term, but because of some things that should concern us, which is the market saying, in a worst case scenario, what is the sovereign default risk? Like, what is the extent to which the government can honor its long-term obligations? What can it pay back these bonds that have an average duration, again, in 15, 16 years from now? That's part of what's in here. I think people still believe in the full faith and credit of the Canadian government. They're probably also factoring in inflation. So they're looking at the United States and they're seeing an economy that's being pump prime by Donald Trump through his big, beautiful bill. And they think inflation needs to be factored into this because inflation is going to erode the value of what these bonds pay you over time. And the longer the duration, the more sensitive it is to inflation. So that in that calculation is baked into it an inflation expectation. But I would point out, and here I'll throw it back to you, Sean, is that same inflation expectation is priced into those American bonds, which are trading at a value, or the value of those bonds have not declined as much as Canada's since the beginning of the year. And the final point is that probably the Canadian dollar is reflected in here, that bondholders buying Canadian debt versus American debt are buying in a non-reserve currency, and they're taking probably some additional risks that they want to be compensated for holding a currency that is not a global currency. So, Sean, I think you put this all together, and you have to start to wonder if Ottawa doesn't have a problem here that it seems to love to ignore at this moment, or it's choosing to ignore, which is that our longer-term borrowing costs are going up. And this matters because Mark Carney wants to finance a lot of these, so-called nation-building projects. And those projects will pay out, in some cases, over many, many years, maybe over decades. And they'll have to go into the market and borrow debt against, future income streams that, reflect not a quick hit, a proverbial house flip, but, debt that is matched to, the duration of the assets themselves. And I think this all points to a somewhat sticky situation for Canada going forward vis-a-vis longer-term debt servicing costs.
Yeah, one of the arguments that we've heard in public finance circles for a better part of a decade is that it made a great deal of sense for governments to borrow because the costs were so low, and as long as the borrowed dollars were being used for something productive, in effect, the government could arbitrage its low borrowing costs. I think what you're showing here is that whatever one thinks about that argument in the past, it's self-evidently not the case moving forward. And so instances where policymakers are going to make the case for borrowing, they're going to have to demonstrate that taxpayers are getting value. But before we wrap up, I think we'd be remiss if we didn't address the elephant in the room, Rudyard, and that is the kind of paradox of the United States. Those of us who follow these issues closely, are familiar with arguments about the unsustainability of public debt and the extent to which that can spiral, including into rising borrowing costs that eat up more and more of government budgets. It seems like the U.S. is a challenge to, or at least doesn't conform precisely to our understanding of these issues. We're seeing not just long-running deficits and debt over the past 20 years or so, but in some ways, as you say, one big, beautiful bill doubles down on debt-financed government. What explains the U.S. anomaly? How is it able to run these massive deficits and not find itself running into the proverbial fiscal wall like other countries around the world, including, as we've been discussing, likely Canada, if it continued down that path?
Yeah, just think of it. The United States is running, a deficit probably this year, 6, 7, 8% of GDP. So easily double Canada's. Yet the rate of change since the start of the year versus Canada in terms of the change in the interest rate, the increase in the interest rate in their long-term debt has been slower than Canada's. And I think it's two words. It's called exorbitant privilege. And that's what you get when you have the global reserve currency. When everybody in the world needs U.S. dollars. You need U.S. dollars to buy oil. Oil is denominated in USD, not Canadian dollars, not euros, not yen. You need USD to often issue bonds. So many countries around the world, especially in emerging markets, they have American-denominated bonds because, again, investors don't want to take the local currency risk when they're buying a bond, especially if it has a longer duration. So there's all kinds of reasons why the world just needs a lot of U.S. dollars, and one of the most liquid and safe ways to hold those dollars is through U.S. Treasuries, which is the single largest, probably outside of real estate, it's the single largest asset class in the world. But unlike a house, you can sell your U.S. Treasuries like right now in a nanosecond on one of the most liquid and large global markets in the world. And I think everyone having to hold a lot of these U.S. treasuries means they have to buy them. And when they buy them, it obviously pushes down interest costs because there's demand for the debt. And obviously the supply, while extensive and while growing, isn't infinite. There's a limited amount of debt the Treasury Department of the United States issues, and the duration of the debt, whether it's short-term, medium-term, or long-term debt, that's all under the Treasury's control. So I think what we always have to understand in Canada is we are not a reserve currency. We are not the United States. No one needs to own Canadian bonds. Most Canadian bonds are, in fact, bought domestically, not internationally. And it's not a deep, super liquid market like U.S. Treasuries, and we got to be careful here. Like, I guess that's my final point. I'll give you the last word in this talk, Sean, is that I just wish we were a little bit more prudential, right? Like, why are we running a $90 billion, according to the CD Howe, deficit this autumn in the fall budget, if that indeed proves out based on Mark Carney's spending preferences? That's seems to be a little bit reckless, a little uncautious, and it just seems odd for someone of Mark Carney's pedigree and standing that he's using, I guess, the Canada-U.S. relationship, the breakdown in our trading relationship, as the basis to spend big and to spend in a way that I think starts to court the risks of a return to the type of austerity that was forced on us in the 1990s. Not out of choice, but out of necessity. We are setting up the preconditions for Canada to revert and fall back into a painful workout and accounting like we had to go through in the 90s to everyone's great cost.
A ton of insight, Rudyard. For those listeners and viewers who want to learn more in Rudyard's exercise in myth busting, they can find his article up on the website. Ottawa's borrowing costs are rising faster than Washington's, doing important work challenging this conventional wisdom that hangs over federal fiscal policy as we head into the budget. And as you just set out, risks actually understating the potential pitfalls to more spending, more borrowing, more debt. Listeners and viewers who enjoyed the conversation, you can hear it, of course, on our podcast feed. You can find it on our YouTube channel. Come check out our YouTube channel. We have tons of videos virtually every day. Subscribe to find those. Rudyard, thanks for joining me, and hopefully let's talk about something a bit more cheery tomorrow.
Absolutely. We'll do it, Sean, 100%.
Bye-bye.